All right, we're looking at the Mr. Danny Willis case study on portfolio management. Let's read question 1. Determine the amount Danny would need to borrow to increase the 1-year return. Show your calculations. Danny Willis, CFA, is the head of portfolio management at Blackwater Asset Management. One of the portfolios he is responsible for managing is a $20 million government bond fund. Danny expects a return of 3.2% over the coming year on this fund. However, clients require a 1-year return of 4%. So this is where that gap is going to come into play, where we're going to need to borrow. So we're expecting 3.2. However, we need to earn 4%. So we're going to need to kind of use leverage to juice those returns up a little bit. Danny believes he can enhance returns by leveraging the portfolio. He can borrow at 2.1% and invest the proceeds in government bonds identical to those in the portfolio. The bond portfolio's duration is 7.5 and the borrowed funds are 0.9. So this is where the leverage comes in. He can borrow at 2.1% and then invest and earn a higher return at 3.2%. So this is the formula we end up using for this question. So the amount we're going to borrow is going to equal the E, which is going to be the portfolio size. And then we're going to multiply that by our required return of 4% minus the expected return of 3.2%, which in this case is the risk-free rate. And then we're going to do that expected return minus the what we can borrow at. So when we plug that in, here's what we get. So we get 20 million times 0.04 minus 0.032 divided by 0.032 minus 0.021 gives us about 14.5 million. So this is what we must borrow to meet that client required return of 4%. Question 2. Estimate the duration of the leveraged portfolio with funds borrowed at 2.1%. Show your calculations. So I think we already read everything we need for this. So the bond portfolio's duration is 7.5 and borrowed funds are 0.9. So we're not actually going to need to use this 0.9 number. That's not going to be involved in the equation here. So let me pull in that equation and what the answer ends up being. So our duration leverage ends up being the portfolio duration times the total amount invested. That's going to be the first portion. And then we're going to subtract what we borrowed and then divide that by our equity. So when we do that, plug in those numbers basically. So we've got 7.5 and then total amount invested is going to be our 20 million plus this is going to be pulled from that last question where we calculated the amount that we needed to borrow in order to hit that 4% return. So the amount we need to borrow there is a little over 14.5 million. So we're multiplying 7.5 times the total amount invested. Then we take out that borrowed amount and then divide that by the equity to get the kind of what that new duration is since we're leveraged. So we get about 12.2273. Question 3. Determine each factor's characteristic that would lead to a lower repo rate. Justify each response with one reason. So I think we need to read some more here. We left off at borrowed funds of 0.9, so let's start reading. Danny also considers leveraging the portfolio using repurchase agreements and is keen on obtaining the lowest possible repo rate. He believes two factors that affect the repo rate are the availability of collateral and the quality of collateral. So it looks like those are our two factors here. So we need to consider these two factors and then what about each factor's characteristics that would lead to a lower repo rate. So this one, let's pull in our answer here. This one's pretty difficult for availability. I think it's tough terminology, but I think essentially for availability of collateral, what we're looking at for is difficult to obtain or rare type of collateral. So basically, if I'm the lender and I'm getting a type of collateral that's not as readily available out there and is more rare, essentially the borrower is going to be less likely to default on rarer collateral as it is more difficult to obtain. Therefore, the lender will be willing to accept lower rate of return. So essentially, we're going to be willing to accept a lower rate of return if we're less likely to default, and we're less likely to default if we really want to get that collateral back that we're posting for the repo. And then on the quality of collateral side, this one's going to be a lot more straightforward. Higher quality leads to lower rate. High quality collateral is going to be less risky. Therefore, lenders will accept lower rate of return. So that's that one's going to be a bit more straightforward. But essentially, we want to get to the point of less risk. What about these two factors makes them less risky? And then if they're less risky, then the lender can take a lower rate. Question 4, estimate the duration gap of Rockwell's defined benefit pension plan. Show your calculations. So I'm going to just pull this formula in right now. So the duration gap is going to be our basis point value of liabilities minus basis point value of assets. And to calculate these two figures, what we're basically going to need is our liability and asset amounts plus their duration. So we're going to multiply the values times the duration and then times it by 0.0001 to get the basis point. So those are the three inputs we'll be looking for when we walk through this. So another portfolio that Danny is responsible for managing is the defined benefit pension plan of Rockwell Pharmaceuticals. The plan has a pension benefit obligation, so this will be our liabilities of $25.5 million with an effective duration of 9.75. The plan assets of $31 million are 60% equity, 40% debt. So the 60% equity, 40% debt, that's going to be important for our duration calculation because we won't have duration for the equity portion, only for the debt. The debt portion is invested in a laddered bond portfolio of Treasury and investment-grade corporate bonds to fund near-term plan distributions. While there's no cash flow match, the bonds are highly liquid and can be sold to meet distributions. The duration of the bonds is only 2.9. Danny has identified a duration gap in the pension plan to hedge. Okay, so I think we've got what we need. So we have our duration of the bonds. However, the bonds are only 40% of the portfolio, so we need to take that into account for the asset side. And then for the liability side, we've got the liability amount and the duration. Okay, so as we mentioned, basis point value of liabilities or assets is going to be the value of the portfolio times duration times 0.0001 to get our basis points. So for liabilities, we've got that $25.5 million times the duration of 9.75 times 0.0001 gives us almost $25,000. Then for assets, we've got $31 million, and then we're going to multiply that by 40% debt times the duration of that debt portfolio, and then multiply that by to get our basis points as well. Gives us about 3,600, and then our duration gap is just going to be the difference between these two. So we get 21,266.5.